Hi everyone, my name is Suzanne Swaneke.
I'm Safa Abdullah.
And I am Amanda Vasquez. We will be talking about Garrison Incorporated. Let's begin with some background information on Garrison Inc. Garrison Inc. is a New Jersey-based manufacturer of construction equipment. A client is able to buy their equipment or lease it. In the case that we are looking at, Garrison Inc. enters into a contract with Donahue Inc. to lease a tower crane. The following lease terms are applied. The tower crane has an estimated useful life of 15 years and will only be leased for 10 years. An annual lease payment of $16,000 must be made, and there will be a $24,000 residual value at the end of the lease. There is no option to purchase the crane after the lease is up. It costs the manufacturer $100,000 to make the cranes and gets sold for $135,000. Garrison begins to face some economic downturns when his competitors begin offering a lower price. His competitors offer a selling price of $125,000 compared to his $135,000. The rate implicit in the lease, assuming the fair value of the tower, are as followed: $125,000 at 6.933% and $135,000 at 5.45%. This arises two issues: how should the lease be classified, and how should the transaction be recorded? Safa will be explaining the classification of this lease.
In order to classify this lease, we looked at FASB code, which is specialized in the leasing area. This code is 840-10-25-1. A lease contract should be treated as a capital lease if the contract meets one of these four criteria. Otherwise, it will be treated as an operating lease. The first criteria is if the contract shows transfer of ownership by the end of the lease term, then the contract classified as capital lease. This criteria does not apply in our lease terms. Let's look at the second criteria. The second criteria is if the contract contains a bargain purchase option, then we can classify it as capital lease. A bargain purchase option allows the lessee to purchase the leased assets at the end of the lease term by a very low price, under the fair market value. This is not mentioned in our lease contract, thus it also does not apply to our case. The third criteria is the term should be 75% of the estimated economic life of the leased asset. In our case, when we divided the 10 years of the contract life by 50 years, which is the economic life of the leased equipment, we will have 67%. That is less than 75%. Therefore, this is also not applied to our lease contract. Let's look at the fourth criteria, and this criteria is the last one. It's the present value of the minimum lease payment should be more or equal to 90% of the asset's fair value. That I will explain furthermore in the next slide. In order to calculate the present value of this lease, we need to take the following steps. First, we looked at each lease value. The first one is priced at $125,000, and this is the cost of Garrison competitors. To get the present value of the lease, we will take the future value of the lease after the 10 years, which is the residual value given to us at $25,000. Next, we will plug in the $60,000 installment. The HOLO will make annual lease payment at the end of each year. The lease term is for 10 years at a rate of 6.93%. When we solve for the present value, we get $195,022. Now, in order to calculate Garrison present value, we will take the same future value payment and year, but change the lease value to $135,000, and the interest is now 5.45%. With this number, Garrison present value of the lease is now $135,009, which meets the last criteria. This number greater than 90% of assets fair value because we divided $135 and $9 over $135, we get a little bit over than 100. Thus, in our lease term, we did meet the fair value criteria, which makes our case a capital lease.
Now, for the second issue that Garrison faces in this case is how to record the capital lease. There will be multiple journal entries for this situation, but first we need to record the initial transaction. Now, in order to record this lease from the viewpoint of Garrison, we must take the $135,009 and debit it to the account lease assets. We use this number because this is the present value of the lease that Garrison is charging for the tower crane. Next, we credit the inventory account $100,000 because this is the cost of manufacturing this product. And finally, the remaining $35,009 is credited to the account gain on lease because this is how much Garrison is profiting from this transaction. Continuing with recording the lease, the next part of the process would be for Garrison to record the receipt of the first installment. Based off of the information given to us about this case, we know that annual lease payments of $16,000 are due at the end of each year, which is shown in the amortization table on the right. In order to calculate the principal and the interest payment, we have to take the present value of the lease, which is the $135,009, multiply by the interest rate of 5.45%, and you get your interest income of $7,358. Next, you take the difference between the $16,000 installment and the interest income to get $8,642, which is your principal. The journal entry which will consist of $16,000 debit to the cash account and then a $7,358 credit to the interest income, and finally the difference of $8,642 is credited to the account lease assets. In order for Garrison to continue to journalize these transactions, he needs to find the difference between the balance and the principal after each period and repeat the process until you eventually get to the 10th period, which leaves Garrison at $24,000, no guaranteed residual value, as shown in the amortization table. Finally, the last journal entries will be recorded are based off of depreciation. Since an asset recorded through a capital lease is essentially no different from any other fixed asset, it must be depreciated in the normal manner. Using the straight line depreciation method, we use the cost of the tower crane from Garrison, which is $135,000, and the useful lifetime of 15 years. When we divide $135,000 by 15, we end up with $9,000. And this is what we will use to record a debit of depreciation expense and credit accumulated depreciation for the next 15 years of the tower crane's useful life. And now I'll pass it on to Amanda to discuss the alternatives.
So why doesn't the alternative apply to this case? There were a couple of options that we had to consider while researching and ultimately to make the final decision. The main alternative to this case is whether this lease is actually a capital lease or an operating lease. Many of Garrison's lease terms corresponded to the standards of operating leases in the Accounting Standards Codification 840, Section 10, Subsection 25, Paragraph 1, but did not correspond with the definition of an operating lease in Accounting Standards Codification 840, Section 10, Subsection 25, Paragraph 43. For example, the ownership is retained by the lessor during and after the lease. Donahue has no ownership and no option to purchase the equipment at the end of the lease. With this lease also does not contain a bargain purchase option. And finally, the lease term of 10 years is less than 75% of the estimated economic life of the equipment, which is 15 years, coming to a total percentage of 67%. Although the present value of minimum lease payments meets the total of at least 90% of fair value of assets at the beginning of the lease, we confirm that this lease is a capital lease. Another alternative that we faced was to record either the $125,000 or the $135,000. We decided to use the $135,000 because this is the amount that Garrison is charging Donahue for the tower crane, as opposed to the $125,000 that competitors are charging for the tower cranes with the same specifications.
And if anyone has any questions, please feel free to ask, and we thank you all for your time.